You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. All right, guys, welcome to a special edition of Lender Lounge here in Las Vegas. We are getting set up for the Captivate conference. I'm here with my good friend Mike.
Hey.
What's up, brother? Thanks for joining us here.
Thank
we
you.
are live with video here in Las Vegas. We're a little casual because we just got off the plane.
All right,
So
yeah.
we're not all fancy dressed up yet. We'll be tomorrow.
Yeah.
But Mike, you're with Sharestates. We see you when before COVID. We saw you every month. We're about to see you about every month now, right?
Yeah.
So introduce yourself and the company, and we'll get started.
All right, awesome. I mean, Sharestates now, it's about 7-8 years now. We're a private lender. Believe it or not, Sharestates actually launched during the crowdfunding boom 7-8 years ago.
Right, I remember that.
So we were originally an equity crowdfunding platform. We switched over to debt a little bit into it. Our investors preferred that more, so we actually crowdfunded debt, did it through private family offices, etc. Our originations far surpassed our family office capabilities. We went the institutional route and grew the company. And now we do everything in the private lending space, so we're different than some of the shops. We do the 1 to 4 family fix and flip, mixed use, multifamily, commercial, ground up, DSCR rental loans, and we do the DSCR on 1 to 4 mixed use and multifamily also.
So you guys are basically doing a little bit of everything and doing it well. I know that. And give me a little bit of history with you. When did you join Share? So were you a founding member or?
So there was the 3 founders of Sharestates. I was the 4th guy into the company.
Oh, nice.
And then I got kind of just jumped into the origination side.
All right.
So we started like that. Believe it or not, I didn't know much about hard money or loans
So
when
what were
I
you
started.
doing? What were you doing before all this?
So before all this, before I even got into working with my partners now, I actually used to manage all the real estate for the MTA in New York. So Metro North, New York City Transit, Long Island Railroad.
Wow.
So believe it or not, they're like the largest landholder in New York.
I'm sure. Government employee going private sector.
Yeah. From there, two of the founders, Ray and Rodney DeVuti, had a title insurance company. I joined them. I had a lot of people in my network. And then Sharestates started launching.
Yeah.
And I was like, I could sell that too. So I started working on that, and then we started mostly actually on the direct side. We work with a lot of guys on direct, and then we grew a big broker business, and from there a couple other things. We have white label, and we have a new version of correspondent on its way as well.
Fantastic. And so when you guys transition, because this is very uncommon, like we don't have a lot of lenders in the space that transition from equity to debt, right? And so what was the crystallizing moment in your business that realized, okay, we got to move to debt. This is no longer viable?
So there was 2 things that happened. The first thing was the investors we were working with at that point, they wanted quicker returns. So you got monthly returns on your capital, which
they didn't want to wait.
They didn't want to wait on the platform. And you had a quicker return of principal. So typically a hard money loan is 12, 18, maybe 24 months. If you went into equity, you might not recapitalize for 36 months or more than that. So if you're doing a ground up project or something.
Yeah.
So that was one of the driving factors. The other one was the demand. A lot of the people we spoke to, they're like, I don't want to give away half my project, or I don't want to give away equity. Let me just borrow money and I'll pay you back quickly.
What year was this?
This was about 8 years ago now. So what was that, 13?
Okay, so very early when the industry was still growing and getting off the ground. And was this New York only at the time, or? So
when we first launched, we were in New York, New Jersey, Connecticut, Pennsylvania, and then we started adding on other states.
And now you're nationwide, right?
Now we're in about 45 states. A couple
That's essentially nationwide.
Yeah, a couple states we just don't want to be in. But we are nationwide.
Right.
I think companies like Jurassic helped us scale to nationwide. So being able to do closings everywhere. So it's pretty cool.
I appreciate that. Thank you. Yeah, I mean,
shout out.
Yeah, and we've loved hanging out with you, and we've had a lot of good times at these shows, but I love seeing your guys's, how active you are in the space, right? And how energetic you are. And you barely sleep. I mean, we know this. This is known in the industry. Mike doesn't sleep, right? But the industry is so booming now. It's white hot right now. And compared to when you guys started, 13, because we started in 07, and we really started getting serious in 12, right? So like, when did you guys start seeing like, okay, wow, we're really making a difference. We're starting to really get, tailwinds on this and start really expanding? What was that like?
I think the moment was when the institutional world kind of jumped into it.
So
We were the
15,
one of
16-ish?
yeah 15
Yeah.
16. We were one of the first people on the institutional side.
Right.
And originally, hard money was that 12 and 2 money.
Yeah.
And once you started getting people into single digits and scaling their businesses,
Yeah.
and we were able to help people scale. So
Right.
if we knew they needed properties, we were able to help them on that.
That's
and
cool.
we partnered people together. Someone ran into an issue, and you realize like, oh, this guy has an issue with his project,
Right.
but I have a guy who's doing the same thing. Probably could partner up, help him out. They can get to the finish line. I could
Right.
get them more money.
Right.
So you started seeing a lot of synergies like that happening.
Uh-huh.
And then once the DSCR loans got into it, that's where it kind of even boomed even more. So that was like
Oh,
4 years
yeah.
ago.
Yeah, yeah.
And I think that was originally, what was it, a Fannie Freddie product 10 years ago?
Absolutely. And that's what's interesting about you guys, because in the past 3 years, as DSCR really took off, a lot of companies doubled down on resi. And they used to do commercial, they used to multifamily, and they just stopped. You guys have stuck by your guns and haven't abandoned the commercial. And I've seen you guys at, commercial real estate development shows, at opportunity zone shows. You guys are there, active in those spaces as well. So, talk about that a bit. So what do you guys lend on in that space besides just the traditional 1 to 4 and multifamily? Mixed use is a tricky thing to underwrite, right? So what are you guys looking for on that?
So mixed use, we do both types of mixed use. So
Yeah.
we're actually underwriting a file right now that's in California, which is retail on the bottom and office on top.
Interesting.
So that's one type of mixed use. That's about a $9 million purchase,
Right.
and we're getting 75 of the purchase on a bridge, which is higher than the typical bridge lender.
Right.
They'd be at 65 on commercial like that.
So you're doing perm rental on a.
No, this is not perm. This is a bridge loan
bridge
on
loan?
that one.
Okay.
But outside of that, on mixed use, typically on normal mixed use with residential component, we are looking for 51% of the property or more being residential. You're looking for a majority of the rents, so I think like 60% plus of the rents coming from the residential end of the property.
Right.
But that's typically, and we can do that on a bridge and permanent financing.
That's
We're also
fantastic.
looking for experienced borrowers on that, so
Right.
not like a first-time guy buying a mixed use.
Right.
These properties weren't as popular like in the heart of the pandemic. A lot of people were scared with retail spots, but right now they've picked back up and they're doing really well.
So on the commercial stuff with the residential component, is there a size that you guys are lending on, like max cap or anything like that? Or
So with all our loans in general, like single family, like 1 to 4, we'll go up to 3.5 million.
Okay.
And then multifamily, mixed use, commercial properties, we'll go up to 20 million.
Okay.
And we've done ground up construction loans as big as 15 million on multifamily.
Right.
So
Fantastic.
we got a mix of
Fantastic.
it.
And you guys are so diversified from that standpoint compared to a lot of your colleagues and competitors. And I think that's giving you guys some longevity. I mean, a lot of folks who take the institutional route, we've seen folks come and go since 13, right? Because you've been in it, active since 13. And a lot of folks come and go. A lot of folks suffered. You guys bounced back real hard with a quickness during COVID, right? I mean, I remember hearing about, your guys' efforts to bounce back. And all right, guys. Well, sorry for the change of scenery. We're now in the exhibit hall at Captivate. The hotel wanted us to move it inside, so we moved it inside. So sorry, bear with us here. So let's continue, Mike. Let's get going. Let's get back going. That was a little awkward. So we were talking about how diverse you guys are from the product offering standpoint. And one of the things that I find very interesting in today's market is how much capital there is in the space. You guys have gone institutional,
Yes.
right? But you also have a direct origination capability. You're not pure correspondent or loan buyer or something like that.
Yeah.
You're staying on the street and working. How are you guys balancing that as an internal operation? Because you are working with other lenders too, right?
So we are working with other lenders as well. We're able to finance it. We have white label. We have white label capabilities for them. Soon, full correspondent with a close in their name.
Right.
We do service like almost all of our own loans as well.
Right.
So to help that out as well, we actually changed the servicing company name. So that's going to be under Investors Loan Servicing.
Okay.
So people will be able to do that. And we also had our institutional buyers that like the way we service loans and how we operate.
So you're
we
working with
have
the
that.
various buyers out there.
So we work with the various buyers. We have our own capital as well.
Mm-hmm.
So we have our own balance sheet capabilities, and we have our platform still. So we still make loans available to our investors online. Like we
so
didn't.
it's still operating. Okay.
So
okay.
the crowdfunding aspect is still operating. We
Okay.
don't want to pull that away from people. People still enjoy getting that. The returns are great.
Mm-hmm.
So that's still rolling.
Let's talk about the crowdfunding component real quick, because you guys didn't do the heavy VC type Fed crowdfunding we saw back in 12 to 15, right? The guys who had a massive operating balance sheet debt and, big, what I can call VC or hedge fund type overlord. You guys really did it yourselves, kept things lean, and it's still operating successfully. You guys didn't do that big type of like, I would consider like a fintech type of approach, right? But, I would wonder like, you probably were approached, right, to take that approach and
We had that approach.
tempted?
We always had that approach,
Yeah.
and we have investors that have come into the company.
Right.
But a lot of what we do is technology based, but it's on our own technology.
Right.
So our loan submission platform, our loan servicing platform, everything is our own technology built from the ground up.
Right.
So you can submit a loan, you can go onto your platform, you can go into your pipeline,
Right.
you could see your loans, you can see how much you could submit your draw from our platform. You're able to see how many loans outstanding you have, what your balances are. You could change your payment dates,
Right.
etc. So.
But from that standpoint, you guys have grown this for a long time. It's still flowing well and it's succeeding. And unlike a lot of your colleagues from the crowdfunding, businesses that started back in 13, right? And so, what do you guys attest to? How do you guys, what do you guys credit to that, like that long success as a crowdfunding operation?
I think it's just adapting to the change in the industry. Okay. So still keeping that component, but
Right.
if the institutional capital came along doing that,
Right.
when it got into DSCR loans doing that,
Right.
and then growing with our borrowers. If you had a borrower that's flipping homes for a bunch of time and they're
Right.
like, I want to buy a 5-unit or a 10-unit and fix it up.
Right.
And if you're not able to help them, that mixed use or multifamily might lose that client.
Right.
So we jumped into that. We actually got into the commercial space, believe it or not. We actually rolled the dice with a borrower. He came in, he said, I'm buying a warehouse. He goes, I'm going to make $1 million when I'm finished. And we're like, you're not going to make $1 million. And the guy's like, I'll pay you 12%. I'll pay you the interest ahead of time. And he's just give me the loan. So
That's how you started in commercial.
Our first loan was on an actual warehouse. And the borrower bought it. He did the work to it,
Right.
and he actually didn't refinance this one. He ended up keeping them after a while, but he was flipping them. He was fixing them and selling them. And on that warehouse alone, he made about $1.5 million.
Fantastic.
And
But that's an interesting proposition, right? Because most lenders, when they enter, it's not driven typically by a borrower demand. It's typically driven by whatever data sources or backgrounds or whatever have you, right? Has that been the primary driver of like your guys' diversification and growth, like repeat borrower need and demand? Is that
so a
the
lot of
biggest
it's
thing?
repeat borrower need and demand. Another part of it is if someone's a real estate veteran, so
Right.
if you look at their track record, the REO schedule, and they own like 20, 30 different types of properties, most of the times that success isn't luck. So if that person comes with a scenario situation, you look into it a little further, maybe not just pass it away right away, and see how you can make it work for them.
Okay.
And it's worked over the years, and we've also created programs from the ground up.
Yeah, and that's interesting as well because you guys are doing. I mean, now a lot of folks are now doing construction loans because Wall Street will buy them.
Yeah.
You guys are doing them very early on when no one would do them.
We were
right?
doing ground up from when we started.
Right.
I think it was popular, and the heavy rehab.
Right.
So
I mean, for our listeners who are thinking about starting on the construction side, it's a completely different loan
Oh, yeah.
to underwrite. Like any best practices or tips there?
So if it's for a borrower, I would say definitely do your due diligence.
Yeah.
If it's definitely different, definitely look at the building codes, look at the whatever town you're doing it in. If it's a single family home,
Right.
Make sure
Municipalities, right? Yeah.
Municipalities
Yeah.
or villages.
Yeah.
If you're in a village, there's an ARB board, and
Oh yeah.
they
That can be a
sometimes
problem.
they will push your plans back, stuff like that. So I definitely would suggest looking into that. Material cost, I think in the last year, everyone has seen like lumber go up and down. Then I went to vinyl, then I went to windows, then delivery time on those items.
Right. And shipping is all delayed now.
Shipping is
yeah.
delayed. We also always catered our products towards the client's need. So if it was a ground up project, to give someone either like a 9-month or a 12-month loan, you're sometimes setting them up for failure. So if you're doing a ground up or a heavy rehab where someone's doing an extension, adding on a floor or dormer, we always knew from that loan it should be an 18-month loan.
Okay.
So we always set it up.
Where do you pick that up? Because like, if you don't have any experience in this new product, like how are you? What resources on the team do you guys have to add those underwriting capabilities?
We're a little bit different also. I mean, myself and the other partners, we were guys that were in real estate that got into finance. There was a lot of people who got from finance that got into this real estate world. So they were doing MCA loans or even in the institutional world. Our first buyer that worked with us on the institutional side was doing MCA and real estate through us. And we kept telling them that you should do the real estate.
Well, because you have that builder's background, that real estate background, so you can understand how to, beyond just the underwriting, it's actually the asset. You know how to value the asset, how to manage the asset, and how to essentially build it if you needed to.
Yeah.
Well, that's interesting. Okay, so I mean, let's talk about kind of. We always talk about 2020. It's not the pandemic's not quite behind us, but I like to say it is. And 2020 was quite a year. I mean, we had our hard times. March and April of 2020 was rough for us.
Yeah.
And I felt like the industry kind of bounced back soon after. How was that for you guys last year? And I thought you guys bounced back pretty quickly, but
I think it was pretty quick. I mean, March we had this was what was it, the first or second week?
Yeah.
We had 20 closings we canceled because just everyone didn't know what was going on.
Was it a valuation concern?
It wasn't a valuation concern. It's just the secondary market shut down.
Yeah.
You're going to sit there on your balance sheets. It's tough. Sit there, hold that, pay penalties, etc. So you wanted to make sure everything's running smoothly. But we got back into it. I think it was by August, September, we got back into lending again. And towards the end of the year, it started really picking up. And then last couple months, it's been pretty busy, and it's back to the normal trends. It was like the crazy May and June, and then July and August still busy, but quiet summer months. Everyone's back in camp, vacation.
Right.
And then the end of the year boom in this industry and in real estate in general. So excited for that.
And so a lot of folks are saying hotter now than ever before, right? Would you agree with that?
I think in certain markets, I think it's also more difficult. You might think hotter because of delays or issues or problems, but when you have appraisal issues, doesn't mean it's a hotter market. I think the DSCR market is the hottest you've ever seen it because the rates have never been lower.
Exactly.
Stuff like that. Fix and flip. Everyone always mentions inventory issues. I think it's still a busy market, and then ground up is busier than it's ever been. There's still an inventory shortage of homes, so that hasn't gone
and that's
away.
the kind of common thread in the show. We've been talking about inventory. Like there's just no houses, right? And so, I mean, where do you see things going in the markets that you're big in? What do you guys? How are you guys seeing things change?
I think investors are learning how to change their value add. If you were typically buying a fix and flip, and you were buying a house for $200 and putting $30,000 into it, and if the future value wasn't there was no value in that anymore, it was changing with the market. So I have borrowers that were like, all right, that's good, and I can make money on that, but if I add a floor and extend it, I can make a lot more money. So it's creating more space.
More density.
Yeah. I think it became more popular. Like everyone knew that like the three bedroom, 2-bathroom house is the most popular home like in America.
Yeah.
So if you had a 2-bed, 1-bath, etc., or something different, it was to make the correct extension or change the layout so it fit the buyer pool.
And that's a pretty common thread you're seeing across the country.
I think we're seeing it a lot across the country. I've seen a lot more for community developments in ground up.
Okay.
So people are buying land and asking for not horizontal. They were looking for more horizontal than vertical. So they wanted to get entitlements, put in, electric, plumbing, roads, and you're seeing a lot of that popping up in all different neighborhoods.
Okay.
So.
And being in 45 states, I did want to ask you about this because like the Great Migration, as I called it, on another episode, is like we've had secondary and tertiary markets which were kind of like not very interesting, all of a sudden become massively interesting, right? I mean, Nashville, Tennessee.
Memphis,
Tennessee as a whole, it's like just, I have never gotten so many phone calls for new lenders in Tennessee. But not just the Carolinas, Florida, Arizona. So where are some new markets that you guys are really paying more attention to?
Memphis, like you mentioned, in Tennessee has been crazy. And now you're seeing like Knoxville and other places pick up.
Fantastic.
The Carolinas, Florida in different areas than normal, so that doesn't make sense. If that makes sense or not, but you used to other places in Florida. Now you're seeing everywhere in Florida.
Right.
Texas, same issue there. Not an issue, but
popularity.
You can't get an appraisal back sooner than like 30 days there now. And then you have the Alabama area. So
really? Alabama,
and this is the two of the most shocking ones. Indiana, so all of Indiana, very popular, and as part of it because of job creation with Amazon warehouses, etc. And Cincinnati, so you see a lot. Before it was regular Cleveland and other areas around that, but downtown Cincinnati, Ohio, very popular.
And that's another kind of interesting topic that we've kind of touched on before, and I'd like to hear your thoughts on this. Is the Midwest has largely been kind of a overlooked marketplace as a whole for private lending, right? We don't see a lot of folks who are concentrating in the Midwestern markets. And we're starting to see some attention being, like you mentioned, Ohio, Indiana. I mean, Michigan's kind of on my radar, but not really. It's starting to, right?
Picking up. I mean, pre-pandemic, so Detroit was picking up a lot. Detroit had a big problem before. They had the fire homes, zombie homes. And you saw a lot of those starting to change. And I think it's getting back to it. Before the pandemic, it was doing great. There's a lot of development. You had a lot of big guys in there. You had what's it, Quicken Loans guy.
Yeah.
Yeah, Dan Gilbert.
Yeah.
So they put a lot of money into it. You saw it pick up, and then other places as well. You see it pop. I think one of the biggest driving factors to what you're mentioning in the Midwest is now people are able to work remote.
Yeah.
So if you can live for half the amount somewhere
Right.
else and still do the same amount of work or be just as productive, then why not move?
So you're seeing a lot of folks who are in coastal markets moving to the Midwest, and that's influencing people like you who want to do business there, right?
Even you'll see people that were living in Brooklyn, they'll move upstate New York. So they'll still be in New York, but it'll be just in a different area because they don't have to go to the city anymore.
Right.
They don't have to travel. They could be somewhere quieter. They could be by the water. So it's a different lifestyle. I think people's lifestyles have changed in the last year.
Definitely, I agree with that. And us in California, we're kind of spoiled in the sense that we've got such large suburb spread and urban sprawl in Southern California. But we see this. A lot of our clients, like in New York, tell us all the time, like people are moving and they're not coming back. They like it up there, and there's no reason to come back, right? And have you moved? Are you still in the city or?
No, I never lived in Sarah, Long Island.
You live in Long Island,
and
okay.
my office is 5 minutes from the house. So it's awesome. And the airport's 20 minutes.
So you've always been in a nice spot. Never had to really leave. We have a lot of discussions about this. People leaving New York and whether that's an interesting question because of our listeners on the multifamily side and our listeners on the commercial side, and our investor clients who have always loved New York. And has New York bounced back?
I think New York has bounced back. You go to the city now, I mean, it's busy again. People are going back to work. A lot of companies mandating, get vaccines and come back to the office.
Right.
So it's come back. People have moved back to the city. So my friends who own multifamily in Manhattan, they said people have come back. They've given rent concessions, etc. But they said people are coming back.
That's good to hear.
They're getting usually the same types of tenants. So,
I mean, at the end of the day, it's still the financial hub of the world, right? And you just can't ignore that. And you can't run a financial services business or investment bank remotely. You just can't. You got to be at the trading desk. I hope you're enjoying this episode so far. This episode is sponsored by PrivateLenderLink.com, where investors and brokers find direct private lending companies throughout the United States. In addition to promoting lending programs, the site also has a unique directory which lists private mortgage investment opportunities. Mortgage investors can use PrivateLenderLink.com as a resource to discover mortgage funds as well as lending firms that offer mortgage and trust deed investment opportunities. Review multiple investment profiles, do some research, and contact each company directly. And for all you loan originators out there who are seeking additional investors for a fund or notes, PrivateLenderLink.com is a great place to advertise your investment offering at a very reasonable cost. So get on your browser and type in PrivateLenderLink.com/investments. There's no fee to search, and registration is not required. So let's talk about Sharestates' involvement on the DSCR side, because you guys do a lot, right? And DSCR is a very hot topic these days because of how interesting it is from a market standpoint, at least from my perspective, because I don't serve a lot of clients. I'm more on the investment side, so my clients are yield hungry. It's not really something for them, but it's a topic that's being discussed because it starts to blur the line with the conventional side, right? And we're starting to see more of our industry try to break into that side, and more of that industry try to break into our side. And what are your thoughts on that? Like how are things progressing for you guys?
I mean, I think ever since hard money itself in general got lower,
right?
It's been doing that. People are like, oh, it's a first-time investor, or oh, it's this, or this guy owns multiple rentals. I think it's important to not mess up the industry or to give it a bad name or to bring in regulation. I think it's the lenders. I think the lenders have a big responsibility to make sure that you QC the files properly. And
don't screw this up for us, guys.
I think that's very important. You've seen people come and go in the industry, like you mentioned before, and you don't want to see that happen. You want to see it grow.
Yeah.
You want to see it stay. You don't want to see this product go away. I mean, it left Fannie Freddie years ago. It came back. And I think it's important to make sure you do the proper underwriting, QC the client properly. Right. And if you're getting those weird questions where it is leading towards, like, it sounds like this guy's going to live here, then you kind of kill the loan, not to just be hungry for that one loan.
Right.
I think
but
it's
I'm
very
starting
important.
to see, and this is kind of, not, I mean, this is a micro version of this, but like I'm starting to see what I would say shades of subprime in the DSCR stuff, right? And I'm starting to see it, and it's starting to get me a little bit nervous, right? Because I don't ever want us to face that type of crisis. I don't think we will because of the short-term nature of most of our products. But DSCR is a whole different animal. They're 30-year loans.
That's why I think it, just like anything else, when you're not creating enough of it,
Yeah.
you kind of try to make it easier.
Right.
So you loosen guidelines, etc. Hopefully people don't stick to loosening them any more than they are now.
Right,
I
right.
think they're at a good spot right now where if you know the borrower well enough,
Right.
and I think that's what's great about having repeat borrowers, you don't have to look for a lot of that. You know that that's what that guy does, and
Right.
that's what the industry is, and he's been doing this forever. The liquidity's there, his credit is good. So you look at certain you know aspects of the loan and make sure you want to stay. But I have seen guidelines change from when these products first came out till
Yeah.
now, and they've
I mean, rates have come down significantly, but
Yeah.
underwriting guidelines have loosened so much that I'm starting to see advertisements for almost like no income and other things like that. And
Yeah.
it's starting to raise. It reminds me of subprime, and I'm starting to see some concern for people who have that long-term industry health perspective. So you're arguing that it's on us. We have to really stick to our guns on this.
I think it's important. It's very much
Yeah.
on us. I think it's very important on the vendors.
Yeah.
If you have an appraiser go out there, unfortunately, it's very tough on them now too. So I think the stats given by some of the large AMCs that are at the conference were saying there's about 80,000 active appraisers, but 40 of them are they're doing the inspection. And then you have 2 million conventional loans they're doing a month, plus the DSCR products. It's not obviously so. I think responsibility falls on both sides. I think it's important. But I definitely don't want to see this product going anywhere. I think it's great for the industry. I think it's a great backup to, let's say someone is fixing and flipping 10 houses and they end up selling 5 and keeping
Right.
5. So I think it is a good backup to the industry itself.
It has allowed this industry to expand significantly beyond the banking industry and the conventional space because we've now taken it out of their hands. Right? Build to perm is now a thing. You couldn't do that 5 years ago. So, and the opportunity that creates on the stickiness, because you guys have a lot of repeat borrowers. You're talking about working with the borrower, right? And that creates so much stickiness with the borrower from a long-term standpoint, right?
Yeah.
But like, I guess my fears have always been, we're gonna do ourselves in almost, right? Because it's a fear of a race to the bottom.
Yeah.
Right. We saw that in fix and flip, right? We saw that, too much leverage risk, too much rate compression, and we're seeing kind of the same trends with much higher velocity with the SCR.
Oh yeah.
Not to mention, now the conventional shops are competing with you guys.
Yeah.
And so, like, that's actually an interesting angle to think about. What are you guys doing to combat those guys? Because those guys have horsepower, man. They've got reps all over the country. And
They have reps all over the country. I think you work with them. I don't think it's something you put away, but if they have a client that's an investor, sometimes they can't handle portfolios. A lot of their products are geared towards single
Individual.
asset.
Yeah.
So you're able to help their clients and kind of help them with their loans. Also, a lot of their clients are doing fix and flips, so the banks don't offer. So they're still
Right.
able to come to you on that.
so you're more
And-
collaborative with these guys then.
I think it's
conventional
important to be
guys.
collaborative with people. A lot of times you walk into a room like this, like a convention hall, and everyone's like, "Oh my God, look at all my competitors." I don't think you should look at it like that. It's your peers in the industry.
Right.
There's plenty of business from everyone. So
And that's how I've always viewed it.
Sit there, yeah.
Right. We're all colleagues.
Yeah.
At the end of the day, we're all trying to grow the industry together, and rising tide lifts all ships. And I think that's why I think it's so important that we get involved with various different means of creating that kind of like industry best practice, like self-governance.
Yeah.
Right. And if we screw it up, then all of a sudden CFPB comes knocking. Or some regular comes knocking. DFS comes knocking. Who knows what's going to happen? And all of a sudden, we got another Dodd-Frank on our hands.
Yeah.
So, listen, to our audience, make sure you're sticking to your guns. Be ready to say no. And that's an interesting question for you. How often do you guys say no?
You say no a lot. Like a lot.
Okay.
So
Tell me more about it. Yeah.
you have people call you with scenarios all the time. It
Right.
comes in like that's rural. He's like, no, but it's a good area. I'm like, there's no population anywhere to be seen. Or
Right.
you have someone calling. He's like, oh, he's a great borrower. It's just his credit got hit because of a divorce. I'm like, everyone's credit got hit from a divorce. Like, you got divorced and no one paid their bills. So you hear that one.
Right.
After 8 years of doing this, we've done almost $3 billion in loans. The amount of different stories I've heard, and you just have to know when to hold them and fold them. I guess now that we're in Vegas, you know?
And that's but at the same time, right? You see that level of competitiveness and that kind of that itch. Right? You don't want to lose a customer, right? And balancing that is tough.
That's
right?
definitely tough. But I don't think it's losing a customer if it was going to make you look bad.
Right.
So
That credit risk isn't worth it.
no,
Right.
I don't think it's worth the credit risk. It takes it's very hard to build like a name in any industry and
Sure.
to do all that and to take one bad apple and to mess up what you've put together. I don't think it's the best idea.
And it can just take one.
Yeah.
Right. And you touched on something there that I want to kind of pull out a little bit is credit.
Yeah.
Right. Credit has been an interesting topic in our space. Not DSCR, you have to, but like with a lot of the fix and flip and the bridge stuff and the traditional asset class for quote unquote hard money or private money. Running credit has become a new trend, in my opinion. For the longest time, it was never a topic.
Yeah.
And I feel like COVID was the year when all the lenders who were in multiple states said, okay, we're no longer going to ignore credit, right?
Yeah.
Right. And so, like, tell me about you guys' evolution on running credit. How was it the same way, or was it before that, or
From day one, we ran tri-merge credit. We wanted to
Really?
see, we wanted to see trade
since
lines.
13?
I think it's important to see a borrower's liquidity and experience. So if
Sure.
they have a regular mortgage on there, have they been paying their own mortgage? Outside of that, they have credit cards. How many years has it been a revolving account? I think it's important to see that. Also to see how much space they have on there. You're giving someone a construction loan,
Right.
and even if you're financing 100% of it, they do have to have money to put in on it.
Sure.
So you want to make sure the credit's available. I think it's important, especially on a ground-up project more than anything. The
Right.
borrower is going to be ordering windows, lumber, a lot more than would for typical. You're going to have to put deposits down now for excavation,
Right.
foundation, etc.
So you guys have been running credit since.
We've always been running credit from our first loan.
Wow. I guess maybe it's more of a West Coast thing then. I mean,
We also had different underwriting guidelines. We were originally a crowdfunding platform,
Yeah.
so we had to raise money online, and you had to show the person's credit. You had to show someone's worthiness. So
That's true.
we had their track
that
record.
transparency was super important for crowdfunding.
Super important.
Yeah.
I don't think that's changed either. I think for your institutional investors, that's even more. They're big on
Yeah.
data.
Yeah, and with that's the one thing that I do really like about the standardization we've seen is the importance of credit. Right? As a former loan officer myself at a bank, credit was kind of a foregone conclusion. But when I came to this space, I was like, "You guys don't run credit? You guys don't run appraisals?" And my underwriter was like, "Wait a minute." But then clients, it's their business. I'm the lawyer, right? So, but nowadays it's become a very much kind of standardized approach, and everyone essentially does some form of credit run.
They do. I think also when the industry was first starting, people were trying to mimic the mom and pop shop. So the
Yeah.
mom and pop was
Yeah.
12 and 2. They were trying to mimic that.
You're being
but
compensated for that risk. I mean, 12%.
You're being compensated, but those guys also know they know their borrowers.
Right.
It was the same guy buying 5 houses a year, but now that guy wants to buy 10 houses and he wants a lower rate, so he's gonna have to show a couple more docs.
That makes sense. And you see the expansions also. You're pointing out that the expansion of the marketplace has insisted on the fact that we standardize practices. Okay, I like that.
I think in general, as the prices came down and different securitizations, they added different steps in there to,
Yeah,
I guess,
that's true.
protect the risk.
And Wall Street has short memories, but they do. I'm sure they're still stinging from '08, and credit was a big topic. So and with securitizations, I mean, are you guys involved in that kind of stuff as well?
We haven't done our own securitization, but
Your buyers are working with you guys on that kind of stuff.
Correct, yeah.
And that's an interesting. We're at an interesting time in the market for that too, because it's hotter than ever. I mean, it's not just for DSCR, but for non-conforming fix and flip loans and construction loans. It's starting to be bought for securitization purposes. Yeah, and that brings a new level of Wall Street to the space.
I think it's a new level of Wall Street. I think it's a new cost of capital. If the direct lender is now doing securitization, they don't have to sell the loan.
Yeah.
And that's just more, I guess, yield and rate compression.
Right, you're taking it back. You're taking that piece back, but that's. I mean, as a lender in 45 states, I mean, yield compression has always been the hot topic for the past, I would say, 10 years now.
Yeah.
I mean, how's it going for you guys? I mean, you're seeing it across the country now?
I mean, when we first started, our rates were 12%,
Yeah.
and now you see on fix and flips, you see certain companies. I mean, we don't go as low, but I don't know what paperwork they ask for. I've seen people as low as 6% on a fix and
I've
flip.
seen those, yeah.
So you see anywhere from 6 to 12 still now. I haven't seen anything lower than that. But what shocks me more is still the rental loans. Like you're in the mid to like even low threes on some of the programs.
I'm seeing. I was predicting the other week on another episode that we're going to probably see 3, and a couple, and then it's eventually going to compete with the regular mortgage loans. It's going to get nuts.
I wouldn't be surprised.
Yeah. Well,
But I think it's similar also to fix and flip loans. When they came in, there was so much space to make money on these loans that everyone wanted to get in the space.
Yeah.
I think it'll also kind of drown out the space a little bit right now.
And there's a lot of people arguing that fix and flip's on its way out, right? And what are your thoughts on that? Because I'm of the belief that there's so much old inventory in the country. There's no way this can go out.
I don't think fix and flip's on its way. You have two things. You have the auctions coming back, the REOs. You have a lot of people that didn't
Foreclosures
move.
are back.
Foreclosures are back. You have figure this right now. How many people had their mortgages on deferment right now?
Yeah.
So you have all those guys in deferment that now it's over and they don't want to pay their bills or they don't want to live in that house anymore. They're going to move. And chances are they've been there a while.
Right.
You also have distressed cities.
Oh, significantly. Yeah.
People are going to go in and fix those. So I don't
Right.
think the loans are gone. It might change a little bit, but it's here to stay. It's
Okay.
it's a business now. There's shows on TV revolving around it.
Oh yeah, we know it. We have some clients on the HDTV. We know about it.
So,
and it's now mainstream, and that's what I love about art. Now that's what I love about the industry is that now what used to be considered almost loan sharking back when I first started. I remember because when I first started Jurassic, my father, 30-year banker, and he was like, "Wait a minute. Is that loan sharking?" I'm like, "No, Dad."
no.
And then I explained it to him. He's like, "Oh, I didn't know that existed." This is back in like 13, 12. Now it's so mainstream, and I want to ask you like where you see this market headed because we're at new market entries. We're seeing new market entries.
Yeah.
It's never been easier to be a new originator. Never been easier to be a new lender, right? And you said I don't think the assets are going away, but like where do you see the industry headed?
I see the industry still growing. I think you're going to come, hopefully, everyone hoping, but I think as the pandemic like really will hopefully end at some point, I think people will go full force into everything.
I like it.
So I don't see it slowing down. There's certain places, and I think we were discussing this before it started, where I have flippers that say, their open houses went from 50 to 15, but he goes at the first time they were doing them, half the people were there just 'cause they had nothing to do. So he says it's the same amount of serious buyers. People are still looking for houses. Their goal pricing hasn't changed. They're still going for at ask or above a little bit, so they're being priced properly. And hopefully it sticks. I could tell you the next couple of years, I think it'll still be hot. 2-3 years.
Well, we
After
always ask
that,
that question on the show. Bullish, bearish, foreseeable future. Next 2 years, you're very hot.
very hot.
Okay.
For the next 2 years, definitely. After that, I can't tell you what's going to happen.
Okay.
But still, right now, you still have a shortage of inventory. So someone has to build it. People
Right.
still need somewhere to sleep.
People need somewhere to live, but I just finished an interview on this question, and I want to get your thoughts on this. While that's still the truth, the popularity of rental, right, and the massive appetite of the Wall Street institutions now buying up large swaths of rental houses, right? I mean, I heard that a certain investment bank went and bought a small city, and and how does that impact your operation on the rental side?
I still think it helps out. I think people find it as a big business. So you've heard the word BRRRR.
Yeah.
So everyone's doing the BRRRR effect. And
Everyone's
they're
doing BRRRR, yeah.
renting homes.
Yeah.
I think we're in a new world now where people also, we talked about this earlier, you could work remotely, right?
Yeah.
So if I could go rent a home in one state for a couple months, like a couple of years, I could live around the world now. So I've seen people even doing that during the pandemic. They moved 3 times.
Yeah.
They're still doing the same work, same job, nothing else. They've just made it easier. So,
But the question that I have about it has always been, doesn't that create a scenario where we're almost trying to, won't it lead to almost like a society of renters, right? And disincentivize the homeowner. And with the prices being what they are too, right? And it's kind of interesting, it's so hard to buy a house. There's no inventory.
Yeah.
It's so expensive, right? And now there's just this glut of rental houses out there to rent from, right? And so it's like, does that reduce this incoming generation of wealth from buying homes?
I think it ruins the concept of community more than anything.
Yeah.
It does a little bit and it doesn't. People will still, if they want to live in a community, you're going to go to the community where people are.
Where you want to live.
Where you're going to actually live, and it's
Yeah.
going to be for the schools, and the taxes are going to go towards the right things
Right.
for you to go there. But we'll see. I mean, it's been popular.
Yeah.
It's a lot of times it's a lot easier for people to afford. We'll see if that changes. But I do think right now with the mortgage rates where they are, you're still going to see a big buying boom.
I hope
don't think
so.
it's going to go away.
I hope so. And I really hope that we, in the incoming generation of wealth, isn't boxed out. And I think that's so important. The best way to build wealth in America is to buy a home. And
I actually think that during the pandemic, I think one of the big things you've seen was people who lived in apartments and other stuff. They're like, why am I, like, once you got actually locked into your box, you're like, why am I doing this? And you've
Right.
seen a lot of people move out, and they're like, you know what? And when they went into the home, they realized, like, this is actually great. And you've designed the home how you like it. You're not
that's
renting
true.
anymore.
That's true.
I mean, the maintenance is a pain in the ass, but
Yeah, but and that's a good point. We had, and part of the Great Migration, right? Like, a lot of folks are moving to smaller. I contemplated moving here to Vegas or moving to Texas. I'm still getting emails from some clients. Hey, move out here. There's a great ranch waiting for you. That kind of stuff. But I don't know if I could do it. But like it's been done. A lot of our clients have moved into smaller cities and bought homes at more affordable prices and that kind of stuff. So hopefully there is hope for that, and I am optimistic as well. All right. Well, I want to close with with one question for you, Mike. This is very unique for you because we see you at all the shows, right? And you're a very busy man, right? And this year we're gonna see you at the show after this, right? The Originator Connect show.
Yes.
And then, but the APL we're not gonna be able to see you.
No,
right? You're having a baby.
Having a baby.
Oh, congratulations, sir.
Thank you.
Second
one. Yes.
Boy or girl?
We're not sure.
Okay.
It's a surprise.
Okay. All right. Oh, you don't know at all.
No, we don't know at all. We didn't do it the first one either.
Awesome. Well, congratulations.
Thank you very much.
And but I want to get your thoughts on where we're going as an industry with these trade shows. Right? Are you excited to be back? And
I think trade shows are great. I always think business in person is better and different than when you can have a drink with someone, eat dinner with them,
100%.
shake their hand. I'm very big on that. All my clients, almost all my clients I've worked with, whether a broker or direct bar, I've actually met them. I've had a drink with them. I've had dinner with them. Personally, I think it's very important.
So these ain't going away anytime soon.
I don't think trade shows are going away. I mean, right now we have this. You have companies like ICSC. They're doing 2 this year because they missed the year.
That's true.
And people want to get out.
Yeah.
You also learn a lot. If I come here and I meet someone who's a lender from the middle of the country and they weren't lending in New York or something, I might have never met them another way.
Right.
So I think it's important.
Well, I appreciate the sentiment because we really do believe that these are here to stay. We're not going anywhere with this one either. So
we'll be at the next one.
Yeah, we'll see you at the next one. And for those of you who are listening in on when this goes live, it'll be after the Captivate conference, but you'll see a lot of great footage from that. And so you'll see this guy all over, I'm sure, because he's going to be everywhere. But this is Kevin Kim for Lender Lounge here at the Captivate conference during setup, and we'll see you on the next one. Thank you for joining us, Mike.
All right, thank you.
All right.
Thank you.
Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.